We have a lot of potential market movers this week: CPI, PPI, bank earnings. How are you telling your clients to prepare for this upcoming week, and also the idea that we could very likely have 2 more rate hikes?
We're going to have some volatility, Frank. We're in that pre-earnings period where companies can't really say a lot about the conditions in their businesses, but analysts are free to lower price targets, change earnings guidance, so on and so forth. So I would expect some. We're in that period that I call it the pre-earnings kabuki dance, where stocks move around, and then the reality is set in when the companies actually report and talk about the conditions in their respective industries and businesses.
Yeah, we're seeing forecasts for a third straight quarter of earnings declines. How do you see that playing out in the market, specifically this week, with some very important earnings with the big banks coming up this week? They'll also give us a sense of the credit situation in the market.
Liquidity conditions are changing, and they're changing rapidly, and I don't know whether the market fully appreciates what's happening since we've signed the new debt ceiling. We've drained over $200 billion of liquidity out of the system. It's a little counterintuitive as we're issuing new government bonds to replace and fund the activities of the government, but that actually drains liquidity. At the same time, the Fed is engaging in quantitative tightening. All that money is coming off of bank balance sheets. So it's likely going to make for more volatile times. Banks will have less capital to deploy over that period of time, while certainly for regional banks, it's even more complicated because they have to pay more to get deposits as they go through this period.
I also want to talk to you about rising rates. Just a short time ago, we were showing a board of treasuries, all of them with a yield above 4%. I want to point you to a vital knowledge note out yesterday, looking at the rising rate environment and saying, in part, we've talked about a 45-50 ceiling for the S&P 500, not a particularly compelling risk reward. Rather than chase the S&P 500, other parts of the market, including banks, energy, small caps, China, et cetera, should perform better. Do you agree or disagree with this thesis?
I completely agree with that, because really this has been an extraordinarily narrow and unusual market. Liquidity that was coming into the system until fairly recently concentrated into the largest technology companies and the largest cap companies. And I think that's starting to reverse itself. We started to see that in June. I think that trend is going to continue because there's a lot more valuation support in small cap stocks and mid cap stocks versus the S&P 500, or even when looking at the equal weighted S&P 500, which trades at a significant discount to the S&P itself, the S&P price earnings multiple.